How to invest in stocks, a beginner's guide to building wealth. Imagine turning a few $100s into thousands all while you sleep. Sounds like a dream? Welcome to the world of stock investing. In just 8 minutes, we'll show you how to get started and build your wealth. Stay tuned. Alright, so, you want to be an investor? That's fantastic. But before you even think about throwing money into the stock market, we need to talk about education. You wouldn't buy a house without understanding the mortgage, right? Same goes for investing. First things first, what even is a stock? In simple terms, it's like a tiny piece of ownership in a company. When you buy a stock, you're essentially buying a small slice of that company's future earnings. The more the company grows and profits, the more your stock is potentially worth. Now, the stock market can seem like this big, scary monster, but it doesn't have to be. Think of it like a giant flea market, with buyers and sellers constantly trading these little pieces of companies. The price of a stock goes up when more people want to buy it than sell it, and it goes down when more people want to sell. Before you jump in head first, take some time to learn the basics. There are tons of free resources available online. Investopedia is a great place to start. They have articles, videos, even a whole investing dictionary. You can also check out books from the library or enroll in online courses. The key here is to understand the different types of investments available. You've got your stocks, bonds, mutual funds, ETFs, the list goes on. Each one has its own risk level and potential for return. Don't worry, we'll cover these in more detail later on. Remember, knowledge is power, especially when it comes to your money. The more you learn about investing, the better equipped you'll be to make smart decisions and grow your wealth over time. So do your homework, guys. It's worth it. Now that you've got a basic understanding of how investing works, it's time to talk about your why. Why are you investing in the first place? What are you hoping to achieve? Setting clear financial goals is crucial. It's like having a destination in mind before you start a road trip. Without a destination, you're just driving around aimlessly, right? Same goes for investing. Are you investing for retirement? Dreaming of retiring early and living off your investments? Or maybe you're saving up for a down payment on a house or your dream car. Maybe you want to start a business or travel the world. Your goals will determine your investment strategy. If you're investing for a short-term goal, like a down payment on a house in a few years, you'll want to be more conservative with your investments. You won't have as much time to recover from any market downturns. On the other hand, if you're investing for the long term, like retirement decades from now, you can afford to take on more risk. The stock market goes up and down in the short term, but over the long term, it has always trended upwards. Think of your financial goals like building a house. You need a strong foundation to build upon. Start by setting small, achievable goals and then gradually work your way up to bigger ones. Write down your goals, make them specific, and put a timeline on them. This will help you stay motivated and track your progress along the way. Remember, investing isn't just about making money, it's about achieving your financial dreams. Alright, let's talk about one of the most important concepts in investing: diversification. This is where the saying, "don't put all your eggs in one basket," comes in handy. Imagine you invest all your money in a single stock, and that company ends up going bankrupt. Ouch, right? You just lost everything. But if you had spread your money across different stocks, even if one company went under, you wouldn't lose all your investment. That's diversification in a nutshell. It's about spreading your risk across different investments to protect yourself from major losses. Think of it like building a well-balanced breakfast. You wouldn't just eat a plate of bacon, would you? You'd want some fruit, maybe some eggs, some toast, a little bit of everything to keep you fueled and satisfied. Same goes for your investment portfolio. You want a mix of different asset classes like stocks, bonds, and real estate. Within each asset class, you also want to diversify further. Don't just invest in one industry or sector. Spread your money across different industries like technology, healthcare, energy, and consumer goods. That way, if one industry takes a hit, your entire portfolio won't be decimated. You can also diversify geographically. Consider investing in international stocks or funds to gain exposure to different markets around the world. This helps reduce the impact of any one country's economic performance on your overall portfolio. Chapter 4. Start with low-cost index funds. Now, I know what you're thinking, Graham. This diversification thing sounds great, but I don't have time to research hundreds of different stocks. And you know what? You don't have to. That's where index funds come in. Index funds are like the superheroes of the investing world. They're low-cost, diversified, and they take the guesswork out of picking individual stocks. Think of an index fund like a basket of stocks that tracks a specific market index, like the S&P 500. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of the 500 largest publicly traded companies in the US. That's instant diversification. The beauty of index funds is that they're managed by computers, not humans. This means lower fees, which translates to more money in your pocket over the long run. Remember, those fees can eat into your returns over time. Another great thing about index funds is that they're incredibly easy to buy and sell. You can buy them through most brokerage accounts, and they're very liquid, meaning you can easily sell them if you need to access your money. Now I know some of you might be thinking, but Graham, where's the fun in that? I want to pick my own stocks. And hey, if you're passionate about researching companies and you have the time and knowledge, go for it. But for most people, especially beginners, starting with low-cost index funds is the smartest and most efficient way to build a diversified portfolio and grow your wealth over time. Chapter 5. Use dollar-cost averaging. Let's talk about market timing, or rather why you shouldn't try to time the market. Trying to predict when the market will go up or down is like trying to predict the weather 3 months in advance. It's nearly impossible. Even professional investors with years of experience and fancy algorithms have a hard time consistently timing the market correctly. So, what's the solution? Dollar cost averaging. Dollar cost averaging is a simple yet powerful strategy where you invest a fixed amount of money at regular intervals, regardless of the market conditions. This could be monthly, bi-weekly, whatever works best for you and your budget. The beauty of dollar cost averaging is that it takes the emotion out of investing. You're not panicking and selling when the market drops, and you're not getting caught up in the hype and buying high when the market is soaring. Think of it like this. When the market is down, your fixed investment buys you more shares at a discounted price. When the market is up, you're buying fewer shares, but at a higher price. It all averages out in the long run. Dollar cost averaging is especially beneficial for long-term investors. It helps you ride out the market's ups and downs and potentially benefit from market volatility. Remember, time in the market is more important than timing the market. By consistently investing over time, you're giving your money more opportunities to grow and compound. Chapter 6. Monitor and adjust. Congratulations. You've educated yourself, set your financial goals, diversified your portfolio, started investing in low-cost index funds, and you're using dollar-cost averaging. You're well on your way to building wealth. But your investing journey doesn't end there. Investing is not a set it and forget it kind of thing. It's important to regularly monitor your investments and make adjustments to your strategy as needed. Think of it like taking care of a plant. You wouldn't just water it once and expect it to thrive, right? You need to water it regularly, give it sunlight, maybe even give it some plant food now and then. The same goes for your investment portfolio. You need to check in on it regularly, see how your investments are performing, and make sure your strategy is still aligned with your financial goals. Life happens, and your financial goals may change over time. Maybe you got a raise, started a family, or decided to buy a bigger house. All these life events can impact your financial plan and your investment strategy. It's also important to stay informed about what's happening in the market and the economy. Read financial news, listen to podcasts, follow reputable financial experts. The more informed you are, the better equipped you'll be to make smart investment decisions. Remember, investing is a marathon, not a sprint. It's about making consistent, informed decisions over time to achieve your financial goals. So, stay engaged, stay informed, and stay the course. Chapter 7. Start investing today. Investing in stocks can be a powerful way to build wealth, but it's important to do your research and start with a solid plan. Remember, education, goal setting, diversification, and regular monitoring are key to successful investing. Thanks for watching, and don't forget to like, share, and subscribe for more investing tips. Comment below with your biggest investing question, and we'll tackle it in our next video. See you next time.